Integrated financial planning and risk modeling, a multinational firm approach, 5-year pro forma and Monte Carlo framework. Introduction. Financial planning today operates beyond static spreadsheets, evolving into a system that integrates uncertainty, strategy, and probabilistic reasoning in decision making. Multinational firms face layered risk from foreign exchange volatility, fluctuating input costs, and dynamic interest rate environments. These variables are interdependent, meaning shift in one can amplify or dampen the impact of others across the financial structure. This framework is going to be introducing a structured approach that combines scenarios planning with stochastic modeling for deeper insight. The model structure. The model is built as an integrated system where operational, financial, and consolidation components interact seamlessly over time. The operational layer captures key business drivers such as sales volume, pricing strategies, and cost behavior patterns. This structure ensures consistency, transparency, and real-time responsiveness to changes in underlying assumption. The key drivers. Revenue performance is primarily driven by sales volume growth, pricing strategy, and overall market demand for conditions. Cost behavior is influenced by input price fluctuation, labor expenses, and operational efficiency level across the firm. Macroeconomic variables such as exchange rates and interest rates introduce external volatility into financial outcomes. Revenue models. Total revenue is derived from both domestic and foreign sources, with foreign earnings requiring translation into local currency. The relationship is defined as the total revenue equals domestic revenue plus foreign revenue adjusted by the prevailing exchange rate. Exchange rate fluctuations introduce variability even when underlying sales volume remain constant. Cost and profit structure. Cost of goods sold is influenced by stochastic input prices, meaning cost volume evolved unpredictably within defined statistical patterns. Operating expenses includes both fixed and variable components, reflecting the firm's operational skills and efficiency. Earning before interest and tax, the EBIT is defined after deducting total cost from revenue. Interest and taxation. Interest expenses are determined by the inputs debt levels and prevailing interest rate, which are subject to market fluctuation. As interest rate rises, financing costs increase, directly reducing the net profitability and the cash flow. Taxation is applied based on jurisdiction-specific rates, reflecting the firm's multinational footprint. The concept of free cash flow, the FCFF. Free cash flow to firms represent the cash generated from operations after accounting for investments and working capital changes. It is calculated by adjusting the EBIT for taxes, adding back non-cash charges, and subtracting capital expenditures. FCF serves as a core metric for valuation, investment appraisals, and financial sustainability. Scenario analysis. The models incorporate three structured scenarios: the base, the optimistic, and the pessimistic, each reflecting different economic conditions. The base case represents the most likely outcome based on current expectations and historical trends. The optimistic scenario, however, assumes favorable market conditions, including stronger growth and stable cost. The pessimistic scenario, on the other hand, reflects adverse conditions such as declining demand and rising input costs. These scenarios provide a deterministic framework for evaluating potential future states of the business. Monte Carlo simulation. The Monte Carlo simulation introduces randomness into the model by generating thousands of possible future outcomes. Each simulation represents a unique combination of macroeconomics, variables, and operational conditions. This approach is going to be in such a way that it will transform the forecasting from a single estimate into a distribution of positive results. The correlation modeling. Economic variables such as interest rate, inflation, and input costs often move together rather than independently. The correlation matrix is used to quantify the relationship between these variables. The Kolesky decomposition is applied to generate correlated random variables for simulation purposes. This ensures that simulated outcomes reflect real-world economic behavior. The FX mean reversion. Exchange rates are modeled using a mean reverting process, reflecting their tendency to fluctuate around a long-term average. Short-term volatility may cause significant deviation, but long-term forces will definitely pull rates back toward equilibrium. This behavior is captured mathematically using the stochastic differential equation. Mean reversion prevents unrealistic long-term divergence in simulated exchange rates. The output matrix. The simulation produces a distribution of the free cash flow for firms' outcomes rather than a single forecast value. Key metrics include the mean, as I've said earlier, which represent the expected value of future cash flows. Standard deviation measures the level of risk or variability around the expected outcomes. Percentiles such as the 5th, the 50th, and the 95th percentile provide insight into downward and upside scenarios. The covenant testing. Financial covenants such as the debt to EBITDA and interest coverage ratios are tested across simulation outcomes. Each simulation is evaluated to determine whether covenant thresholds are breached. The proportion of simulation which breaches represent the probability of financial distress in the firm. This provides an early warning for potential liquidity or solvency issues. The capital budgeting. Investment decisions are based on a host of other things. However, it's also based on the probability adjusted outcomes rather than single point estimate. Projects are accepted if the likelihood of generating positive NPV exceed a predefined threshold. Downside risk is also evaluated to ensure losses remain within acceptable limits. The liquidity planning. Liquidity planning focuses on ensuring sufficient cash reserves under adverse conditions. Minimum cash buffers are determined using the worst case scenario, such as the 5th percentile of free cash flow for firm. Additional safety margins are included to account for unforeseen shocks. In conclusion, the integrated framework transformed financial planning into a dynamic, risk-aware decision-making process. It combines operational insights and advanced modeling techniques to capture uncertainty effectively. By moving beyond the static forecast, the firm gains visibility into a full range of possible outcomes. This enables better capital allocation, improved liquidity management, and enhanced resilience. Ultimately, uncertainty is no longer a threat but a quantifiable dimension of our strategic control. Thank you.